Market fluctuation is a fact of life. Over the past century, there have been bull markets and bear markets. The bears have been extended periods lasting on average 17 years. The last decade was particularly painful for investors. Many investment strategies did not perform up to expectations. And based on the average length of past bear markets, we may not be out of the woods yet. Let's look at $1,000 invested over this time period. Traditional thinking has been, investments that produce higher returns usually carry a greater level of risk. But during the lost decade, common diversifiers followed the same path as U.S. stocks. Bonds were good diversifiers, but with interest rates at historical lows, where is an investor going to diversify today? Now let's look at that same portfolio of stocks and bonds with just a modest addition of alternatives. The difference is clear. But what exactly are alternatives? Broadly speaking, an alternative is any investment that doesn't fall into the categories of traditional investments, namely long-only stocks and bonds. But the more contemporary explanation of alternatives usually refers to investments with the ability to invest long and short, with the ability to invest in different asset classes, not restricted to an investment style, and not dependent on the market going up to achieve positive returns. Because they can go long or short in any asset class, managers of alternatives have more potential investment opportunities compared to many traditional managers who are restricted in the types of investments permitted in their portfolios. As a result, alternatives as an asset class have had low historical correlation to traditional investments. This means their returns did not follow the same path. Over the last decade, when traditional investments lost significant value, many alternatives gained in value. And for this reason, some think they are a great way to diversify a portfolio. Of course, we all know that past performance is no guarantee of future results. Many institutional investors were early adopters of alternative investments. An annual survey of more than 700 educational endowments and foundations, including Harvard, Yale, and MIT, showed that the average allocation to alternatives in 2002 was 24%. This number rose to 52% by 2010. In another survey, both U.S. institutions and retail-based financial advisors agreed that the biggest driver into alternatives has been the desire to diversify portfolios. The majority of these investors said that alternatives will become as important or more important than traditional investments by 2015. Of course, we wouldn't recommend or want to suggest that individual investors can or should invest exactly like institutional investors. Institutions have different investment goals, timelines, risk tolerances, and assets to work with. Individual investors should consult their financial advisors to develop a portfolio that meets their unique financial needs.